Welcome to the All Financial Hour podcast with Steve All.
Steve, how you doing today?
I'm doing great. A little tired is about the easiest way to put it. We had a quick weekend trip. I took the staff with spouses for a little training off-site. That went quick, and then a good friend of mine is doing the craziest running thing that I've ever heard of in my entire life. It's a calendar run. It's like 1 mile on day 1, 2 miles on day 2, 15 on day 15. So you got it all figured out. 25's 25, 30's 30. And it's like, no, I'm not doing that. Too many trips around the sun for me. I am not even going to even entertain that, but he has. So I'm trying to do everything I can to support him. So when we were off on our vacation, I did 5 and 10 mile runs. And then on Monday when I got back, spent all the time getting home. And then Monday when I got right back, he had 28 miles to cover on the 28th. And he had just done 27 on the 27th. So I looked at it and I said, okay, I'll do 20 for him.
That's still crazy.
So it was like I ran 8 in the morning and then worked all day long and then went to Queenie Park and hiked another 12 and got home late, tired, and then go from there. So other than that, because I'm training for an endurance event, 29029, where you climb up ski slopes with no snow on them. So that's a big event in August. And then I got the New York Marathon in November. And it was like, those trainings start like now, and it's like 3 to 5 miles. You know, and so I tried to support him doing anywhere from 8 to 12 miles or more per day. Is just, it wears you out. It's the time.
Yeah.
You know, that's what I said. With the event that he had for it, I'm not that fast. So for me to go 20 miles in a day, it took a long time, is about the easiest way to put it. So we've done all that. Now we're back here in the office going. The month of May is probably the craziest month for me. I grew up north of the track in Indianapolis, so I make my annual pilgrimage, to the Indianapolis 500. And when I got to go with some people, I got to meet Zach Brown and the people at McLaren. It was phenomenal. I didn't like Zach when I would listen to him talk on Drive to Survive, but talking to him on an individual basis, completely different guy. To talk with him at that time, they had not won the constructors in Formula One, but just to sit down and talk with him, I go, wow, this is not the same guy I see there.
Right.
So it's a very, very busy month for us. I'm going to plug one real quick while we're here. Shred event. We usually try to do our shred event right after tax day. But because of the training when taking people off staff and things like that, we didn't get it right after tax day. So our shred event is on May the 17th, which is a Saturday, here at the office from 9 o'clock to 12 o'clock. Anything you got wants to shred, bring it in. If you've got them old binders that you had things in 20 years ago, they take those. Paper, they take those. You don't have to remove paper clips or do anything like that. But go ahead and bring, if you've got something or a document for taxes that you want to get shredded.
And again, that's May 17th from 9 until noon. Come out and get to meet the All Financial Group team and shred some of that old paper, everything but cardboard boxes, okay? That's the deal. Now, you're mentioning taxes, okay, and retirement and achieving goals. Well, a big thing that's been taking place through this weekend here, another big celebration. You talked about the month of May. Well, on the cusp of it here, of course, the Kentucky Derby. The most thrilling part of the race, though, is not the exhaustive hours of pre-race coverage. It's not even the first 2/3 of the race. It's that stretch to the finish line. And, of course, we've got the silver wave going. A lot of people are in the home stretch leading up to retirement here, with a lot of baby boomers starting to age out of the workforce and look for that next part of life. So that means they may be asking the question in this home stretch of retirement, should they convert from a traditional to a Roth IRA, or should they wait? So, Steve, you're all about achieving goals and doing things at the right time. What is the sweet spot to make that conversion move?
I look at Roth conversions. I think Ed Slott kind of puts it better. If you get too much money in your IRAs and 401ks, you're going to subject yourself to tax rate risk in the future. And because of the changes that they've made in it, they took what used to be one of the greatest assets that we could pass to our kids and made it one of the worst assets we could pass to the kids. Why? They can't stretch them anymore. Kids only have 10 years to take it out. So I usually get asked the question, what's too much? And I said, the average IRA and 401k is about $189,000, right in that area. So if you've got an extra large between $250,000 and $750,000, chances are, depending on pensions and your lifestyle, you'll spend those assets down during your lifetime, and it won't be such a tax time bomb on your kids if they have to spend that down, take it out of the IRA accounts. They don't have to spend it. They just have to get it out of the tax shell. They might be able to do that, and it might not really hurt them. But if you've got a double X, $750,000 to $1.5 million, chances are you're not going to spend all those assets down. Depending on the number of kids that you have, how is it going to affect them in taxes? And if you've got a triple X, 1.75 or above, chances are you're going to pass a tax time bomb onto your kids, because they're going to have to take that money out over a 10-year period and pay the taxes on it. So that's what I like to look at it. If you're in that category where you think you might have more money in those taxable accounts than you really want to have, I believe it's time to give us a call. Why? Because I believe reducing or eliminating taxes in retirement is the greatest thing you can do for a successful retirement. So if you have more than $500,000 in investable assets, give us a call now. Let us run that tax analysis. Now, I use that $500,000 figure because of the fact the Roth conversions and the tax planning calculations really shine through if your numbers are greater than that.
Well, Steve, I'm sure you and I are both out on the roads all the time. In fact, I was a traffic reporter for 20 years before getting into this profession, and the problem of distracted driving only continues to grow, even with the infotainment systems built into cars and whatnot. And there are 3,000 people that have lost their lives, and over 400,000 were injured in distracted driving accidents across the U.S. 29 states have now enacted hands-free laws, basically banning drivers from holding their smartphones. That's the main thing, because then you can enforce texting laws better. There's also hands-free, though, when it comes to saving for retirement. And some people like to set it and forget it, or they use a target date fund or a robo-advisor. So, Steve, at what point is it time for savers to take the wheel and seek the help of a human advisor? In fact, someone like you that's been in this thing for a long time.
Well, let's go real quick on the robo-advisors. Well, they only got so many programs. So it's not like you're going to get custom for you. They're going to ask enough questions. They're going to put you in a certain type of a portfolio or a mix. It's not real deep. Target date funds. I can still remember back in the late 90s when you had 401k options across the board, individual stocks, mutual funds here. You could pick so many things. People were overwhelmed. So people did not participate in their 401ks because they didn't know where to put their money. There were too many options. So then target date funds come along. Target date funds basically say if you're going to retire in 2025, pick a 2025 target date fund. If you're going to 45, go to 45. The problem with a target date fund is that's the only thing that it's looking at. When are you going to retire? It doesn't take all the other information into it. Doesn't take how old you are. Are you a conservative investor or an aggressive investor? What other assets do you have? You know, is this the only asset that you have? Because the target date fund's only looking at that. What about your income and expenses? Do you have a pension and you're not going to be needing to pull money out of this for a while? So that's where we start to look at it, is if that's the only option, because most people, when you sign up for it, they're going to automatically enroll you in the 401k, and it's going to go into a target date fund. So it doesn't really ask a lot of questions about you from where it's at. And that's where I look at it. I think it's more important when I look at somebody in the investment world. I love the fact that with Market Guard, I can be as aggressive as you are. You know, if you want cryptocurrencies, blockchain, I've got that. Individual stock portfolios, I've got that. Income portfolios, dividend portfolios, ultra aggressive, ultra conservative. And that way it's designed to meet you, not to meet somebody like you. And I think that's the biggest difference between the two. So if you're over 59 and a half, unsure how to invest your 401k, Call now. Ask for that 401k x-ray. Allow myself and my team to assist you with looking at what you're currently doing in your 401k, what options you might have within your 401k, and how we might be able to assist you.
Well, I know, Steve, you and the team can also help people try to process what's been going on with the big plunge recently in the stock market. Oh, wait, then there was a big recovery. Well, strategist Ed Yardini tells CNBC that he thinks, anyway, some of the worst could be over.
Yeah, there's plenty of things to worry about, but the market is actually holding up pretty well. I mean, we're still basically in correction territory. We got very close to bear market for the S&P 500. The NASDAQ got into a bear market for, a few days, and now we're back in correction territory. I think, Americans are great. When we're happy, we spend money. When we're depressed, sometimes we spend more. As long as there's a wherewithal, and the initial claims data show that the labor market's hanging in there remarkably well.
Hey, we like the words remarkably well. So, Steve, do you agree with Ed that maybe it's time to push more money into the market for growth?
I think it depends on your situation and where you're at. I don't think there's a blanket statement that says jump in. It depends on where you're currently at, what your risk tolerances are. But I started to look at it, those 3 to 5%. Remember the day we were up 5%, and the next day we're down 7%.
Crazy,
we're
yes.
up, and it's like, holy crap, this sounds a lot like I've seen this before. When was it? And I looked back at 2019 because I remember August of 2019 because I was at an investment thing. One of the days the market took a tremendous drop and the next day it was up. So I said, what caused all that? So I pulled up an article, and you talk about deja vu. September the 3rd was the article. And it says
2019.
Of 2019.
Okay.
And it says, okay, why do we have the volatility that we have? Well, Donald Trump is going to put tariffs on China. Donald Trump felt that the Federal Reserve, he should be fired. Powell.
Yeah, Jerome Powell.
And I'm looking at it going, that's the same thing we're talking about now in
really
April
is.
of 2025. So markets, histories kind of follow each other. Past performance is no guarantee for future, but once all the dust settled on that, the markets kind of did what they were supposed to do. As he put it, it's been resilient. It's been done remarkably well for everything that's going on. So the idea that I have is, please focus on the long term, because that's what we need to focus upon.
Yeah.
So do you have a financial plan that you can focus upon? Because the only guarantee that we can really make is markets are going to go up, they're going to go down, or they're going to stay the same. Is your plan designed for whatever happens in the market? So give us a call now. If you don't have a plan, call, set it up. Ask for that comprehensive retirement plan so we can give you something to focus upon during the times when we have the crazy stuff that's going on right now. But if you've got it, call the office. I'll send you the article that if you looked at it and it didn't say August of 2019, you would think it was listed for today.
Oh, my God. Steve, you need to start getting on these cable news panels, okay, and talking some sense to them. And making
Wait a minute. No. Yeah, those the talking heads that go on there, my deal is to help people.
Yes.
I believe that a lot of the stuff that comes on that is to drive ratings and advertising dollars.
Sure.
It's a lot easier to sit here and say, if things are going to go crazy, I can give you a worst case scenario, and people pay attention to that.
For sure. Well, if you have a question
if you can say
about
everything's
that,
going to be okay, that doesn't drive ratings like some of the negative news.
No doubt.
Most people, whatever their biases are, that's what they're going to find. If you think markets are going to be fantastic and you search it on your Google account, you're going to find things that show it's fantastic. If you think the market's going to be crazy, you're going to do your Google account and you're going to find things that say the market's going to be crazy. It's nuts. And that's what the problem of it is. We used to get the news, and they gave us the news and allowed us to interpret what it meant. That's not what happens today. They tell you what they think. So be careful watching the news. But I'll send you that article. I mean, when I read it, it's like, oh my. If they could put April on this instead of August, it would almost fit exactly like it is today.
Thanks for listening to the All Financial Hour podcast.
Insurance products are offered through the insurance business All Insurance Group, LLC, AIG. All Financial Group, LLC is an investment advisory practice that offers products and services through Impact Partnership Wealth, LLC, IPW, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by All Insurance Group, LLC, AIG are not subject to investment advisor requirements. IPW and All Insurance Group, LLC, AIG are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. All Financial Group, LLC is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by All Financial Group, LLC.
This radio show is intended for information purposes only.